So we're MBA Cohort 1, Team 8, presenting on EFU General Insurance Company Limited, and our topic is going to be implementing business intelligence. Team 8 comprises of myself, Zuhair Kamran Inam, Emma Su, Janet Velasquez, Andrea Sylvester, and Yukiko Hata. Moving forward, talking about EFU General Insurance Company, it is a public listed company on the Pakistan Stock Exchange based out of Karachi, Pakistan, that is the largest provider of non-life insurance across Pakistan. The company offerings include insurance cover for fire, engineering, marine, aviation, motor, miscellaneous services, and window takaful, which is often referred to as Islamic insurance. With a diverse customer base, and the company writes all classes of industrial, commercial risks while catering to retail businesses in the areas of travel, motor insurance, to name a few. In terms of the largest competitors of EFU, we're looking at Jubilee General Insurance, IJI General Insurance, Adamji General Insurance, TPL General Insurance, and Century General Insurance Limited. EFU operates through an extensive network of 47 local branches all across Pakistan, all reporting to the head office in Karachi, Pakistan. When we're talking about the major industry trends across the insurance industry in Pakistan, we came across 6 discoveries. The first one being the low insurance penetration and high growth opportunity. By global standards, the overall insurance penetration remains very low, and the share is split 36% for non-life insurance and 64% for life insurance. Various reports imply that the Pakistani market is nascent with large growth potential. The second point is digital innovation. Digital channels such as online sales, mobile apps, and WhatsApp chatbots are becoming significantly more important, and the industry is moving towards a massive digital shift for expanding consumer base. The third point is growth in takaful Islamic insurance. The takaful segment is showing high growth rates, such as general takaful growth rate in 2024 was 24%. Therefore, insurance companies are adapting to Islamic insurance demand to capture segments that were previously underserved. The fourth point is underwriting risks. Inflation, rising repair asset and replacement costs, motor traffic accident frequencies all place an upwards pressure on claims. Additionally, because of Pakistan's geographic situation, climate risk and natural disasters remain meaningful potential shocks. The fifth point is regulatory capital framework strengthening. There are competition market structure issues, such as the Competition Commission of Pakistan finds that state-owned enterprises dominate and the competition is constrained. Additionally, Pakistani insurance companies are not allowed to have operating licenses in other countries, restricting them from expanding globally. The last point is the shift in business mix and lines of business. Growth is certainly faster in lines of business such as motor, health, property damage, assets, and etc. In general insurance, growth in gross premium was mainly contributed by increased auto premiums, fire and property, and marine. Also, as businesses and households acquire more assets, such as homes and vehicles, the demand for non-life products increases. In terms of the chart of insurance premium and claims, we see that the insurance premium quarter over quarter remains stagnant. It does not change, and it remains fluctuating between 3.448 billion and 3.471 billion. And we can also see that the net insurance claims and other costs associated to claims remain stagnant between 2.4 billion to 2.3 billion, with the ratio of insurance claims versus premium coming out to be 67% and 71% for Q3 of 2025 and same period last year, as well for 9 months accumulated for this year and last year comes out to be 56% and 57%. When we discuss the problem that EFU is currently facing, we understand that the core challenge facing EFU General Insurance Company Limited is the escalating volume and cost of insurance claims, which is compressing profitability and straining operational efficiency. The claims ratio for EFU General historically ranges between 56% and 56% to 71%, which is shrinking their gross profit margins. The issue is amplified by Pakistan's regulatory environment, which restricts locally incorporated insurers, whether headquartered inside or outside of Pakistan, from underwriting risks beyond Pakistan's borders. Additionally, due to fiscal and monetary challenges, the government has imposed a super tax on companies producing over 10 billion Pakistani rupees in net profit. As a result, large domestic clients across key sectors such as oil and gas, FMCG, textiles, cement, steel, food processing, and trade are increasingly relocating operations to the Middle East, attracted by a more supportive regulatory framework and stronger growth prospects. This migration directly reduces the domestic insurable base and intensifies competition among the local insurers. Consequently, for EFU General to sustain performance and protect margins, it must focus on driving down claims frequency, reducing claim severity, and improving overall claims management efficiency. The severity of this problem for EFU General Insurance is high and strategically consequential, as it directly undermines the company's core revenue model and long-term competitiveness. With claims ratio fluctuating between 56% and 71%, EFU is consistently paying out more than half of its earned premiums, leaving limited room to absorb the rising operational expenses, regulatory levies, and inflation-driven cost pressures. At the end of this range, EFU's underwriting profitability becomes extremely thin, making the business increasingly vulnerable to volatility in claim severity, catastrophic losses, and inflationary shocks in repair and replacement costs. Compounding this financial strain is the shrinking insurable market within Pakistan. Regulatory restrictions prevent EFU from diversifying premium income internationally, while the outflow of major corporate clients to the Middle East, especially from high premium sectors such as oil and gas, steel, and cement, directly erodes EFU's ability to sustain premium growth. A smaller pool of high value clients combined with increased competition among insurers intensifies underpricing risks and further pressuring margins. Additionally, the imposition of the super tax disproportionately impacts insurers such as EFU that historically generate large profits. This not only reduces net earnings, but also constrains reinvestment capacity in critical areas such as digital transformation, fraud detection systems, insurance and reinsurance analytics, and operational efficiency initiatives, capabilities that EFU urgently needs to control in order to control its claim costs. In aggregate, the convergence of high claim ratios, regulatory limitations, market contraction, and additional taxation creates a severe multi-phase threat to EFU's financial stability, operational resilience, and future growth potential. If not addressed strategically, the problem could shift from a profitability challenge to a structural weakness in EFU's long-term business model. Now we will present our solution. Based on analysis, the most effective and sustainable way to reduce EFU's high claims expense ratio is an AI-driven risk-based customer filtering strategy. Now, the top global insurers such as Progressive, GECO, Allstate, and State Farm have demonstrated that the key to controlling claim costs is reducing exposure to high-risk customers and expanding portfolios of safer, low-risk policyholders. Therefore, we propose four AI-enabled components. The first one is early risk detection. AI can identify the high-risk customers before the claims occur by analyzing historical data, behavior patterns, and risk indicators. This helps EFU prevent losses rather than simply reacting to them. The second component is personalized pricing. Using AI, EFU can tailor premiums to individual customer risk levels. This attracts a low risk but high value customers who improve the overall loss ratio. The third point is fraud detection. AI can automatically detect abnormal or suspicious claims pattern. This reduces fraudulent payouts and protects EFU's financial stability and financial integrity. The automated processing component is our fourth point. By automating approval for low-risk claims, EFU can significantly reduce operating expenses and improve efficiency. So together, these four components deliver measurable impact: lower claims paid, lower management expenses, a better loss ratio, and a high long-term profitability. Importantly, AI gives EFU the ability to detect and prevent risk before it appears, creating a sustainable competitive advantage in the insurance market. Now we will demonstrate the AI architecture that enables this solution. Based on benchmarking against leading US insurers, we recommend a predictive modeling architecture using three proven AI platforms. Google Vertex AI, used by State Farm and GECO, it is ideal for predicting accident probability, fostering claim severity, customer risk scoring, and fraud detection through using BigQuery ML. It supports large-scale predictive analysis and exactly fits EFU's data environment as well. The second AI architecture portion is AWS SageMaker plus Amazon Fraud Detector. AWS SageMaker combined with the Amazon Fraud Detector tool used by Allstate and Liberty Mutual is best for predicting repeated claims, detecting fraud patterns, and analyzing regional claim behavior in real time. The last component is Azure Auto ML plus Cognitive Services. Azure Auto ML and Cognitive Services used by Progressive Insurance and Tokyo Marine It enables claim frequency modeling, loss ratio forecasting, and industry-specific risk tiering and text analytics on inspection reports. After comparing all three, our final recommendation is Vertex AI-based predictive risk architecture. This architecture delivers the highest accuracy in predicting high-risk customers, combines pricing and fraud detection into one platform, and aligns with EFU's current data setup. It is also used by global insurers like AIG, Chubb, and Allianz, and therefore concludes our proposed solutions. Now, when we look at the anticipated impact on the financial side and operational side is two specific line items on EFU's income statement. The first is decreased net claims paid, and the second is reduced management expenses. The decreased claim part is more accurate predictions and fraud detection will directly reduce the claims payout costs, and the management expenses reduction, automation and efficiency gains in claims processing will lower the operational costs. The positive impacts is that faster claims processing and reduced manual workload, as well as early fraud detection and accurate reserve allocation. And the last point for the positive impacts being personalized pricing and competitive differentiation. However, the risks and challenges with this proposed solution are the fact that data quality issues and over-reliance on automation can be a big problem. The regulatory compliance and ethical biased risks is another problem. And the third one is the extensive need for human oversight and transparency requirements. The alternative solutions that we discovered while doing this was that customer education. Now, customer education, this alternative focuses on providing clear education to customers about how the insurance products work. It includes creating self-awareness campaigns around risk management. However, we ultimately decided to prioritize business intelligence because it offers more quantifiable and data-driven results. The challenge with customer education is that although valuable, its impact is difficult to measure, and it often takes longer to materialize. The second portion is improving underwriting results. We also considered improving underwriting results by developing a structured, non-algorithmic guideline such as mandatory risk scoring checklists and human-driven risk tiers such as low, medium, or high. However, this approach remains limited by human judgment and manual overload and inconsistencies. Business intelligence, on the other hand, provides quantitative, scalable, and objective insights that manual underwriting cannot have, which is why we ultimately prioritize business intelligence. And the last one is full reinsurance. We discovered that reinsuring entire projects or policies was considered. However, it was rejected due to the potential high cost associated with fully reinsuring a certain project or a certain policy and the direct loss of control over the risk management. In conclusion, we identified that EFU's claims ratio costs are extremely high. So our overall solution was to use and implement business intelligence to build a predictive model that helps the company detect risk patterns earlier and estimate the likelihood of claims and make smarter decisions around pricing and overall risk management. Thank you so much.